From the morning reading, SPX, NDX, Dow Jones, and oil rally on Friday. Ready, set. 8 of 9 sectors moved higher on Friday. XLF, XLB, XLE were the strongest sectors, while XLU was the weakest sector. Oil rallied $1.72 to close at $29.02. Breadth strengthened as advancers led decliners 3.83 to 1 on the New York Stock Exchange, and decliners led 3.25 to 1 on the NASDAQ. SPY holds 181 support area again on Thursday, as it did on August 24th and January the 20th, and finished with a late rally closing at 182.86. Futures rally overnight, and SPY gaps higher near 185 on the open on Friday, then tests the gap by pulling back to 184, after which buyers took over, driving the SPY to a 186.63 close. All sectors except XLU rose, TLT bonds fell, and TNX interest rates rose. Despite Friday's rally, new highs in the New York Stock Exchange fell. The S&P 500 had its best day in weeks, but the number of 52-week highs in the New York Stock Exchange fell to its lowest level in 2 weeks. That raises concerns that what we're seeing is just another dead cat bounce, a typical bear market rally that's doomed to fail. But prior instances of contracting new highs on an initial rally off the low have not supported that idea. The S&P 500 carved out an island reversal over the past 3 days. This happens when price gap down to a new low and then gap up the following day. It doesn't happen often in the broader market, but when it does, it's a good sign if sellers did not immediately return. Crude oil jumped 10% from what had been a yearly low. Again, as noted in prior reports, this kind of behavior has preceded major long-term rallies in the past 30 years, including 86, 90, 98, and 2008. It has now happened twice in a month. It doesn't say a lot about the short to medium term, but over 6 months to a year, returns have been abnormally large. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:16 a.m. Central Time, and I'm recording this in preparation for the market day of February the 16th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And of course, what we're dealing with right now is really all the action since Friday. So the Sunday night open, the half-day trading on Monday, and then the Monday night into Tuesday morning overnight session. So kind of got one of those mixed bag kind of trading signals. In terms of this is really reflecting activity over a couple days. Right now, the S&P is well up, though it's given up about a third of where it was at one point. At one point, it was up about 34 points on the S&P futures. Currently, at this time, the snapshot, it was up about 22, or a little over 1%. Russell's up about 1.3%. NASDAQ 1.6%, and Dow up over 1%. Crude oil's up about 1%. Euro is down a little over 0.8%. Bonds down about 1/3%. And gold down about 1.82%. Gold has had a contract rollover, so be aware of that if you're a futures trader in the gold markets. Overseas action, we now have China back open, so everything's back to normal on this stance. China up over 3%, and the overnight Hong Kong up over 1%, Japan up marginally, Germany down about 0.5%, United Kingdom up about 1/3%. In terms of macroeconomic reports for today in the United States, we have Empire State Manufacturing, and we have the Housing Market Index, which is a yellow report, probably not a major player. Looking forward, tomorrow we have building permits, PPI, housing starts, capacity utilization, and industrial production, and the FOMC meeting minutes. So quite a bit of action coming up tomorrow. And then after the market closes, you will have FOMC member Bullard speaking. In terms of current volatility conditions, as you would expect with the Friday action, things have ebbed somewhat. Short-term VIX down to a 22.71. Skew still benign. IV percentiles are elevated, though they have started to come down a tad. On the S&P, it's a 48. On the Russell, 62. On the NASDAQ, a 58. And a 57 on the Dow. We did have standard deviation moves put in on 3 of the 4 indices on Friday, and these, of course, were up moves. That was following several days of relatively quiet close-to-close action, though some of these had some pretty big wicks just to get back to where they kind of were. We had some relatively small close-to-close movement in some of those days. In terms of the charts, we can see that we had with Thursday's action that reversal pattern, which did confirm on Friday. So we do have a confirmed short-term reversal pattern across several of the major markets. And then, of course, we know if I look at the futures contract, we've had a big move, and the in effect the combined overnight action between Sunday night, Monday, and Monday night now. So we definitely have confirmed a short-term bottom. Whether this, as the morning reading inferred, with breadth really weak. And of course, the action on Monday with that big move was on extremely low volume. It was just futures without all the market participants. Really low volume, even for a futures contract. That big move, could be called somewhat in question. So we're going to be watching today when all the cash participants come in, how this is treated. Does it fade that gap? Does it fade back towards this prior level? Or does it set up for a continuation pattern? So right now we have the low, and the low is set in a short-term reversal pattern, but we need to see a higher high and a higher low to really kind of feel like this thing is really got some legs to it and is going somewhere. In terms of the Russell, similar pattern. In terms of the NASDAQ, you can see I got futures on here. We've had, a clear, obvious, confirmed short-term bottom, the big wick on the Doji, confirmation coming out, and then the Globex action. And you see what I was talking about with this futures volume. So this action that has happened since Sunday night on very little participation. So we'll have to see where that just really goes. As you would expect, bonds have pulled back. So you could say that that's had a confirmed reversal top. Big wick up there, confirmation here, and then action so far in the futures, again on low volume, confirming that action. So inverse relationship to the broad markets. Gold has been a significant mover in this, and you see, look at this parabolic move. We've been waiting for gold to break out for a long time, and it seems to be setting up to have done just that. If you, in quotes, missed this move, this is not yet the time to jump in. Wait for this reversal pattern to pull back and retrace, and then set up for a bull flag. And so you could be looking for a bull flag entry here. Not yet. It's not yet done that. And let's look at the volatility. And again, a reversal pattern here, which is rolled over. So again, very low volume. Look at that, the volume on the futures contract here. Super low volume. So we'll know more about this in the next day or so as to what this really truly means. In terms of our daily report, let's go ahead and go there. we still have plenty of reasons to be cautious and defensive in this market when you look at these larger signals from the daily report. I will absolutely give it that we have a short-term confirmed reversal signal off the bottom, but is it more? Well, right now, on the intermediate terms, we're still phase one, bear flag, toe in the water, selling puts and reduced stock positions kind of setup. In terms of the portfolio investor posture signals, the IBD market in correction still stands. The accumulation distribution score in the S&P is a lousy E. The NASDAQ's also a woeful E. GMI index actually dropped a notch to a 0 out of 6, still retaining that sell signal that has been in play since 12/10, or over 2 months now, almost 2 months and a week. In terms of the stock charts decision point scoreboard, we still have, at best, in the short to intermediate term, some neutrals, but certainly a heavy dose of bearishness in those signals, with one lone green signal that's hanging on in the Dow Jones since February the 1st. In terms of position sizing opinions, both the mechanical signals here are very poor, with the portfolio investor position sizing opinion coming in at 0% and the volatility coming in at less than 50%. In terms of the intermediate term market posture, again, nothing here yet to get overly anxious about being a bull. You have, with the S&P, a severely bearish reading at 14.5, which would mean no new short-term or intermediate-term bullish trades. The Dow, the NASDAQ, and the Russell also all very poor. Now, the Dow is at a 20.4, but still in the very bearish. So it's the only one that's not actually in severely bearish. We also have the very bearish sentiment line, which is also riding with this, which usually means that we have longer and more pronounced bearish legs and much shorter and poor follow-through on the bullish legs. So until these postures change, we're going to be very defensive and very suspect of any rallies. And indeed, rallies can be looked at as first and foremost as an opportunity to reload for the shorts until proven otherwise. In terms of the next one, and this is a new table here, but basically what I'm using is the very long-term intermediate posture, a 5-year weekly, with the bearish signal being across below 80, and you can see we've been below 80 for quite some time. And I guess I cut off the dates down here. I'll have to grab a new chart. But anyhow, bottom line is this shows us a little bit about the strength of the current trend, and you can see the strength of the current bullish trend is exceptionally weak. Hedge warning status retains that 2+. Again, very defensive. It's saying basically that the conditions are ripe for a significant down move. It's not a prediction that we're having a down move, nor how far that down move may go, but the conditions are certainly ripe for that down move. In terms of specific warnings, we see market in decline, VIX futures up over 18, distribution day count still retained in that market and correction stance. Our VIX phase has been increasing until the last day. We'll see if that trend starts to flip out. Current week out expected move is a 69, so that continues to be severely elevated. Anything up over about a 40 we consider elevated. Indeed, with that new high candle on Friday, the New York Stock Exchange new highs, new lows, you notice only had 95 with a 1-month new high coming into play. That's pretty poor, and it again goes back to this breadth. In terms of intermarket risk aversion indicators, all 5 are flagging as risk off. And fear and greed index of 24, somewhat better than we were a week ago, even a month ago. So, we clearly, this is one of those things that's showing some sensitivity that we have come off those bottoms, and yet still in the extreme fear category. So let's not get too complacent just because we had a good day or two we need to be quite defensive still. And indeed, with the special opinions, option income strategies, cover calls, and put selling, all of these special opinions are still in a very, very defensive stance. And indeed, for novice traders calling for essentially to stand on hands and not really initiate any new positions. Now, if you're going to initiate a new position, if you're a more aggressive trader, you like to go in early, keep that position size in check. Go for closer targets. Take those measured moves, those fib extensions, etc., and go for the closer targets. Be very careful with your stops. You see a bearish candle form in those patterns, you may want to tighten up those stops to right behind that candle. So that's the kind of environment that you're in if you are going to go after a long bullish trade. At this point, you've got to be very, very risk averse to make sure that that thing follows through. In terms of sector specific, you can see we've had some improvement, a lot more neutrals here with that action of Friday, and indeed that probably will improve today if this current overnight action holds up. And yet at the same time, you know, this is clearly not healthy. There is no sea of green here across the time frames and across the sectors. So improvement and a confirmed short-term bottom, but not much more than that quite yet. In terms of sector percent change, you can see the financials led the day on Friday, up 4%, and followed by some very healthy percentages on a number of the other markets. Only utilities falling. Of course, utilities has been the hero during much of this recent weakness and had really gone almost parabolic itself, so that it would give up something much like what bonds gave up on Friday is absolutely expected. In terms of the relative rotation graph, you can see, again, utilities and real estate are the two groups that are holding up the best, and almost everything else has been really, really quite ugly. So really no other industry group or sector. Perhaps XRT, you could draw some attention here, you know, obviously coming from the worst quadrant into a better quadrant. You know, we need to move towards this direction to really be healthy, but certainly we'll note that XRT real estate, I should say retail, get that out right, retail is improving, so that's something to kind of note there. Let's see, I think that's probably enough for today. And as always, if you find that what you're getting from here is helpful to your trading, there's a couple things that you can do. One is you can subscribe to the YouTube channel. You can also like us on the YouTube channel. You know, there's no charge for this morning market preview. And if you find this helpful, one of the ways you can give us a pat on the back is by retweeting us to your Twitter followers, to your StockTwit followers, liking us in YouTube. And of course, you can subscribe to the YouTube channel. When you do that, also note on YouTube, there's that little gear box, and you can click that to access the settings. And one of the things that you can do there is make sure that you're watching it in high definition. Once you get that notice that the content has been posted, wait a couple minutes, let it show up in high def, play it back in high def, you'll see the charts much clearer. Also, you can also control the playback speed. If you go to 1.5 speed, you can probably cut the time in which it takes to listen to this video substantially and yet still understand all the feedback and commentary that's being offered. The rest of these I'm going to just scroll through. If you see something of interest, just hit the pause button, go to that hyperlink, and go to identify some additional information about that resource. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers, and you see the hyperlink at the bottom to go to the full list of disclosures. We'll see you back here tomorrow morning with the Falcon Global Market Preview. Good trading.